Hello, everyone, and welcome to our latest Bucks Trustees Network webcast on the subject of charitable trust investments and how to balance capital growth and stable income. We're delighted today to be joined by Ruadhri Duncan and Tom Lindsey from Sarasin and Partners, who are going to be giving us a brief presentation and then answering a few pre-submitted questions from the network. So welcome to Ruadhri and Tom, and over to you.
Brilliant. Many thanks, Henry. We would put together a presentation to cover the question that we've been asked to answer. But before we do that, just a brief introduction. Sarasin and Partners, as you may know, is one of the leading charity managers within the sector, and both myself and Tom are partners within the firm. We sit within the team, and all we do is look after charities. So the exam question, as Henry's already alluded to, is getting that right balance between predictable income as well as the ability to support that ongoing grant making. And we've sort of summarised it in this chart because ultimately it is a balance. You can't have all of your cake and eat it. We do need to ensure that both tomorrow's beneficiaries and today's beneficiaries have what they are seeking, which clearly for tomorrow's beneficiaries is protecting that capital value against inflation so that trustees in perpetuity can spend the right amount of money and the pot continues to grow against inflation, whilst generating an income for today's beneficiaries so that you can make those grants. And that, broadly speaking, filters through to a CPI plus target, which is how investors and managers like to think about things. The inflation, obviously, for tomorrow's beneficiaries and whatever you're looking to spend on an annual basis as that monetary figure. So just taking a step back for a second, why do charities own investments? Well, they clearly need to grow that capital ahead of inflation whilst generating that income stream for beneficiaries of today. And broadly speaking, that's done through a diversified stream of assets, which we will go into further detail during this presentation, what we mean by a diversified stream of assets. But before we do that, let's just take a step back. If inflation is what we're looking to protect against, both for the long-term capital, but also we want that income to grow ahead of inflation as well. So it's on both sides of the scales there. We can see going back over 100 years that in various decades, inflation has been quite varied. Indeed, when you look at the 70s at over 13%, inflation would have been quite corrosive. For the 90s, the noughties and the 10s, inflation was falling away, and then we walked into the 20s and inflation is over 5%. So it certainly isn't dead and buried, and that post-COVID blip where inflation hit 12% in the UK was of a concern to trustees. And we can't overlook this because the corrosive damage that inflation does over a 10-year period at even 2.5% is to reduce spending power by 22%. And at 5%, it goes up to 40%. So, inflation has been running at over 5% so far on average this decade, which if you hadn't got those assets which would protect against inflation within your portfolio, you could well have seen your capital spending power reduce. Now, supporting trustees and giving guidance to their investments are a number of documents. I won't go through them all, but you can see here we've got the Trustee Act, we've got Charity Commission guidance, and ultimately the predominant signpost is that trustees should have a duty of care. They should take proper advice and make sure their investments are suitable and diversified. Now, I've spoken about a diversified stream of assets. What do we mean by that? Well, in this chart, we've broken them down between two buckets, if you like. We've got on the left-hand side here the core asset categories, which are the sort of things that would make up the majority of the investments within the portfolio, and hopefully they're all familiar to you. We've got bonds, both government and corporates. We've also got inflation-linked bonds, and then we've got equities, both globally and obviously for those UK charities that want to have a UK slug of equities, we've got UK equities there, and then finally property. But that's not all that you can invest in, because we've also got some peripheral asset categories, these assets that might not be held permanently, but as the economic cycle ebbs and flows, it may be able to enhance value or indeed protect value, depending on your view of the future. So we've got a bit of global property there. If you're perhaps a bit more positive about life, you've got private equity. If you're a bit cautious, you might have absolute or hedge funds. And then we've got commodities, which have done very well of late, infrastructure and high yield bonds. So you have got quite an array of assets that you can use to get that diversified asset stream, generating both capital protection and income for today's beneficiaries. What's that look like on a risk metric? Because obviously you want to get those returns, but within a medium risk framework. And this chart is really just illustrative to show you that on the bottom left, you have the probably lowest returning, but the most predictable asset class, which is cash. You then move up into the blue with bonds. You've got perhaps some hedge funds or funds of hedge funds, property, equities, and then the most volatile and the most rewarding asset class, of course, is private equity. Tom.
Thanks, Rory. So I think the extent to which we own those asset classes and the proportion we have in each is in large part dictated by the strategy. And the strategy in itself is then dictated by the time horizon that we're looking to invest over. So I think this is a really important slide just to anchor what we're talking about today in sort of broader context. It would be remiss of us not to say that any cash that's required for short-term spending, and we typically think about that over a 0 to 24 month time frame, should be held in cash and cash equivalents. Next sort of rung up the ladder would be medium-term reserves, where there is the potential for some capital expenditure or spending over that time frame. Over this period, obviously there's the ability to take some risk and adopt some volatility, but given there's known spending, the level of exposure to some of those higher risk asset classes that Rory talked about is a little less. And then we're into the really long-term reserves. And I think for the purpose of today's presentation, we're really talking about something similar to that endowment strategy there that we've highlighted, but 5-year plus reserves that are being invested over the long term and that are able to take risk to allow us to protect against inflation, as Rory said, and ultimately generate that real return which we can spend on today's beneficiaries whilst protecting the capital value and critically the spending power of that capital for the beneficiaries of tomorrow. So more on the right hand side of this chart today, but important to see it within that framework. So if we look at that endowment strategy, how has that evolved over time? So here we're just taking you all the way back to the 1900s. Clearly the level of asset or the amount of asset classes that were available to investors and charities back then were significantly less, and portfolios were typically made up of UK government bonds and UK equities. Really, it wasn't until the 50s that equities became a mainstream asset class. And over time, you can see that strategy has really moved to adopt global equities to a greater extent, and also other asset classes as they've become more mainstream. So the introduction of alternatives in the early 2000s, and to a lesser extent, corporate bonds a little earlier. But critically here, the message is that a strategy that's invested in the long term does need to evolve and be broadly diversified in order to help you generate those inflation plus returns and a level of sustainable withdrawal that you can spend. So diversification, absolutely critical. What do we think that sort of a strategy looks like today? This is our endowment strategy, and it's something very similar to the way in which most long-term UK charities are invested. The majority of portfolios are typically in equities. Why is that? Well, they are the asset class that ultimately gives us the best protection against inflation over the long term. Companies' shares are fundamentally linked to the real economy. They help us give that inflation protection. Property, to a lesser extent, is also well correlated with inflation. And then we have some diversifying assets there in the form of bonds and alternatives, which you'll recall from Rory's risk and return chart, fall somewhere lower down that slide. Over the long term, on the right-hand side, then you can see the sorts of returns that those asset classes are likely to deliver. And equity is really the engine room of the portfolio, generating returns of just over 7% per annum, we think, for the next 5 to 7 years or so. And that's really where you're going to be getting that inflation protection from, as I say, linked to the real economy. Typically, as prices rise, companies are able to pass those price rises on to their consumers. And that's how we end up with that inflation protection as equity investors. So in aggregate, a portfolio of this kind, we think, is going to generate returns of between 7 and 7.5% per annum over the period ahead. Less an assumption for inflation, which we have in here at 2.8%, gives a real return, so a return after inflation, of about 4.5%. Now, that is before costs, and obviously there is an inflation assumption in there, which we have to be conservative about. But you can see that you've got a bit of margin for error there when we think about the level of spend that most long-term charities are looking to achieve. So if the 4.5% is available in theory to spend, how might that be generated? Well, we think it's increasingly important for charity investors not solely to be focused on just the natural income that those investments produce, so the dividends from the equities, the interest from the cash and the bonds, and the distributions from the property assets. Actually, increasingly now, long-term charity investors are adopting a total return approach to distributions. That is enabling them to take an element of capital alongside that natural income, again, which helps smooth that spending profile over time, to my previous point about diversification. Why do we encourage charities to take a total return approach to spending? Well, whilst dividends over the very long term are generally pretty stable, there are moments in the economic cycle where we can see volatility and companies elect not to pay such high level of dividend distributions, and that can be particularly pronounced in certain different parts of the stock market and different geographies. And indeed, back in the global pandemic, we saw actually UK dividends were particularly hard hit in that environment, and they fell by about 30 to 40%. So a charity investor solely reliant on dividend streams had a really turbulent time in terms of the level of spending that they were able to make in that period. Actually, investors who adopted a total return approach and were able to supplement some of that income with capital, or that had held back previous dividends, were able to smooth that effect over time. Likewise, those that had taken a more diversified and global approach, you can see, had less of an effect in terms of the volatility of those dividends, which fell only 15 to 20% on a global basis. So further evidence for taking a diversified global approach, but also a total return approach to spending, rather than just relying on any one source of income. So when we look at that sort of 7%, 7.5% or so return from an endowment style strategy over the long term, how is it composed? The inflation assumption there at the top of about 2.7, 2.8%. What is remaining? Well, there's the income generation of about 2.3%, and then a real capital gain of 2.2 from which you can choose to spend. So in theory, a pot of about 4.5%, that real return I mentioned previously, from which you can choose to spend. We would advise a level of caution about spending all of that income if you want to have a sustainable approach over time. If you choose to spend all of the income and all of the real gain, often you can find periods of time where actually you're eating into the real value of the capital. So a conservative approach to spending, we think, is appropriate. Over the very long term, looking forwards, rather than spending all of the 4.5%, we'd be suggesting to charity investors that 3.5% would be a more sustainable starting point. That said, we certainly have clients who are spending more, 4% and north of 4%, but they are doing so mindful of the potential declines that they could see in the capital value if inflation were to rise, for example. Why do we worry about that sustainability? Well, this table just shows you that the level of return from this sort of a portfolio over time can be quite volatile. As you can see, inflation, and Rory has already highlighted, can also be quite volatile. If you pick out the 70s there in the middle of this table, you can see whilst returns were high, inflation was even higher. And so after inflation and after costs, there are actually whole decades where you couldn't have afforded to have spent 4.5%. Whilst the long-term average is closer to 3.8%, there are periods where it is markedly higher and markedly lower. We think, as I say, looking forwards from here, a conservative starting point is to be spending about 3.5% on a total return basis. As I say, if you want to spend more than that, then there is a potential danger of eating into the real value. We certainly have clients that do it, but critically, they're doing it knowingly. So in conclusion then, finding that balance between today's beneficiaries and tomorrow's beneficiaries is really a judgment between the level of growth and distribution you want to be taking from the portfolio and the sort of an asset mix that you could be adopting. A well-diversified long-term charity portfolio today with roughly 70% in equities is generating an after-inflation return of about 4.5%, which, allowing for a bit of a buffer for inflation to potentially run hotter or for returns to be more disappointing, comfortably supports a spending rate of 3 to 4% per annum, and that's certainly the case for the vast majority of the charities that we look after.
Well, thank you, gentlemen. That was incredibly interesting, as always. It's always good to keep abreast of the current situation and understand the position in the market and what charities can do to be most effective in how they manage their investments. We've had some questions from members of our Buckinghamshire Trustee Network submitted in advance, and I wonder whether we could just jump straight into those, if that's okay. So the first question is, are there simple ways for smaller charitable trusts to manage investments without needing very complex financial planning?
Yeah, thanks, Henry. I mean, that's a really important question, and we have a number of small clients who come to us with similar requests. I think the good news is that actually the charity investment management market has evolved to adopt very tailored solutions to smaller investors in a way that just wasn't the case 5, 10, 15, 20 years ago. So the availability of what we call pooled solutions, but multi-asset funds that allow smaller charities of all sizes, and typically with very, very small minimum investment sizes, to access pretty sophisticated investment solutions. The breadth of those offerings has really increased pretty markedly in recent years. So certainly we and all of our major competitors offer what we would call charity authorized investment funds. So single asset class, funded solutions that provide multi-asset class portfolios that are readily accessible. So in terms of the underlying investment offering, I would say the breadth there and the quality of that offering has increased markedly. And then also I think in the breadth of information and the quality of information available to lay trustees and small charity investors has also increased. So organisations like asset risk consultants, ARC, and other consultancies publish a huge amount of data that is widely accessible for free, which allows groups of trustees with smaller investment sizes to make really good decisions about what sort of funds might be appropriate for them in terms of the risk profile, the underlying exposures, with good understanding of the performance track record and the sorts of managers that are available. So I think comforting to hear, I hope, but lots of solutions on offer, lots of good information out there today, and certainly some good intermediaries that are able to help trustees and charities of all sizes when they come to making these sorts of decisions.
Thank you, Tom. And I wonder what a sort of typical minimum would be to access one of those funds.
Yeah, so taking our CAIFs, our charity authorised investment funds, as an example, the minimum tends to be somewhere in the region of £5,000 to £10,000. Some I think are even lower than that. I think at that sort of level, we need to make sure there's sufficient cash aside to meet expenditure. But I think typically the minimums are low enough to capture most organisations that have got sufficient reserves to think about investing.
Yeah, I think that's good to hear for the very small charities that may have accrued a small amount of cash that they want to put aside for the future. It's good to know that option exists these days. Thank you. So next question from our network was, what are the steps that a trustee should take if their trust wants to improve the balance between growth and predictable income?
So if we were to start from the very beginning, you've really got to look towards your policy statement. Everything that you want to achieve within your charitable investments should really be down in the policy, and we then from there go back to the slide that we showed during the presentation, which is getting that balance between today's beneficiaries and tomorrow's beneficiaries. If we're trying to optimize, we want both to be at the right level. We want enough inflation protection within the portfolio to ensure that the long-term capital grows ahead of inflation. But at the same time, we want to give away as much income on an annual basis so that the beneficiaries of today can benefit from that pool of capital. Now, there are a lot of charities that we look after that at any stage may skew for a temporary basis towards tomorrow or today's beneficiaries. So, for example, if there are a big capital projects or spends, you might decide to spend 7 or 8% for 2 or 3 years, in the knowledge that perhaps you're going to then underspend going forward from there. Equally, there may be those that are looking to spend in 10 years' time who may underspend today. But ultimately, making sure you get that balance over the long term is the most important thing. And revisit your policy statement, look at what you're trying to achieve, reflected in your inflation plus target, and that will always keep in the forefront of your mind what it is that you're looking to achieve, so you don't get that creep, which can happen with charities where you overspend, and then realise actually your reserves aren't at the level that you'd like them to be going forward.
That's great. Thank you very much. So that's it for our questions. I'd like to thank you both very much for your time and giving us such a good insight into the market and especially helping some of these very small charitable trusts with your advice and guidance there. So thank you very much.
Pleasure.
Thanks, Henry.